You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo.
Hey, what's up, Market Moose? Mike from The Moose on the Loose. I hope you're doing well on this Thursday. Today, we're going to talk about a very specific topic, payout ratios. So, I got this email yesterday from one of my members, and he's like, Mike, I don't get it. You seem to kind of like Capital Power, but when I look, and Capital Power, the ticker is CPX.TO, but when I look at the cash payout ratio is like minus 450%. I mean, how in the world a cash payout ratio could be that bad? Or like, what does it mean in the first place? And that gave me the idea of like talking about cash flow, not cash flow, but cash payout ratio and payout ratio today on the Moose. Not necessarily to talk about Capital Power, but to use that as an example that when you take a number out of context, it's not good, even if the number is good. In this case, of course, minus 450% means that the company is spending a lot more cash flow. So it is negative cash flow. So therefore, they don't have any money to pay the dividend. And of course, they have to borrow money to finance that juicy dividend payment for shareholders. So when you say when you say it that way, oh, the company has to borrow money to finance the dividend, doesn't seem right. and it's a good reflex, and it is not a sustainable situation. However, you have to put that into a larger context. So first, we're going to talk about how the ratio is calculated, because that's number one. When you're thinking about the payout ratio, there are like 4 different types of payout ratios already. So you have the classic payout ratio, that is the dividend divided by the earnings. So dividend per share divided earnings per share seems pretty straightforward, right? The thing is, the earnings per share is calculated using accounting principles. So if a business is asset heavy, chances are it has a lot of amortization or impairment charges on their balance sheet, which has no impact on the cash flow but will affect earnings. So for example, if they have like $5 million in amortization, well, that $5 million, it's not money getting out of the bank account. And it's still there, the money is still there, but the value decreased, so the earnings decrease, and therefore the payout ratio would also go up. After the payout ratio, you have the cash payout ratio. Then it will be the ability for the company to pay the dividend based on its free cash flow. Once again, if you have a capital-intensive business, Capital Power is a pretty good example where the business needs to spend a lot of money on new projects, needs to invest a lot of capital. Well, the free cash flow will be negative on that year. It's like the year that you buy your house. Well, if you would have to pull out a cash flow statement, your free cash flow would be negative that year. If you're buying a house like at $500,000, you have like $100,000 in cash down. So therefore, you're minus $400,000. Of course, you're going to have to get a mortgage to finance the rest of the house, and it's going to be fine. But for the business, it's the same way. It would show that you just spent way too much money into your projects and you do not have enough cash flow to pay the dividend. And the cash payout ratio ignores if you get more debt. Once again, I have to tell you this, like several times, it is normal and expected for capital-intensive businesses such as telcos or utilities or pipelines to show negative cash payout ratio from time to time. But eventually, this situation is not sustainable. You cannot get into more debt every single year for the next like 50 years and still think it's going to be okay. So it's all right to borrow money to invest in the future and eventually generate more cash flow. but that part needs to happen at one point. So you need from those projects to be able to generate enough cash flow to pay down your debt and still pay the dividend. If not, it's not going to work out. So whenever you do a filter and you say, oh, I'm not going to invest in any stocks with a payout ratio above 80%, well, you're cutting off great companies that may have something that happened in their earnings over that year, which would affect the payout ratio, but does not affect their ability to actually pay the dividend. So I remember Broadcom, for example, ticker AVGO, big tech company, very popular these days. And I've discussed this one like back in like 2016, 2017. And this business is growing by acquisition, like heavily. So from time to time, they were reporting very weak earnings per share because of acquisition cost and amortization and all those other accounting adjustments that was related to their acquisition phase. And because of that, they were showing like ridiculous high payout ratios and very weak earnings. But the company was generating a lot of cash flow. So you have to be careful with that. Same thing with the cash payout ratio. So when it's very high or when it's negative, you have to know, okay, so what's going on? Well, for Capital Power, they're making a lot of acquisitions. They have a huge CapEx plan, so a lot of money going into their infrastructure to improve their grid, to build more power, to transfer into renewables. So it's normal that right now they are in a phase of major investments, and they will be showing negative cash flow. Now, it's up to you to determine if this negative cash flow is like a good thing for the long run, if the company is using the cash flow to actually buy quality assets and generate more cash flow in the future. It's always the bet that the company will take, and this is what they will try to like sell you in a sense. But I mean, they believe in it. It's not like they're trying to fool you around. But sometimes, it doesn't really is a success. So, of course, it is less comfortable to invest in a company like this versus a company like Procter & Gamble that has all their numbers in line, like the cash flow payout ratio, the payout ratio, everything balances. It makes your life a lot easier. So you don't have to go into those more complicated cases. You can ignore them, but I'm just letting you know that if you just look at a number without the context, it doesn't mean much. You need to understand how it was calculated, which numbers were taken, for which period it was taken as well, and what's going to continue to happen in the future as well. On a side note, you also have two other type of payout ratios. You have the distributable cash flow payout ratio. That is usually it's an homemade calculation made by the company. You will see that by investment firms. You will see that with that will be like distributable income payout ratio. You will see Enbridge is using distributable cash flow payout ratio as well. So they are detailing, they are showing you what's the calculation, so that's a good thing. But keep in mind, it's not in generally accepted accounting principle. It opens the door to interpretation as well, so it's not perfect. Over time, though, it's going to be a good thing, so you'll be able to follow those calculations and make sure that it's still makes sense. And the last type of payout ratio will be the FFO payout ratio. So the fund from operation or adjusted fund from operation for AFFO. Those two are used mostly for REITs, but sometimes utilities like the Brookfields love to talk about FFO payout ratios. So based on the funds from operation. So a little bit more tweaking to explain how the money is coming into the bank account and is there enough money left to pay the dividend. One thing I would tell you overall is if the business continue to thrive, showing like revenue growth, dividend growth, and then you see either earnings or cash flow growth over a long period of time, well, then you kind of have your answer that the dividend is safe. But if you have like shaky numbers for the dividend triangle and it doesn't make much sense and it's struggling or slowing down and the business is not able to generate any kind of growth, well, then if you have like a weird payout ratio, it's probably because things are not going that well, and you have to dig a little bit deeper in the financial statements. Unfortunately, that's always the final answer is going to be found with the real numbers. So you have to crunch those numbers. You have to not be afraid to look into quarterly and annual statements. I did a pretty good example last week, doing a deep dive into BCE actually. So if you're curious about it, you can look at on my YouTube channel. I explain the debt situation, the cash flow situation, and also explain how it's not affecting my judgment that BCE is selling assets to pay off debts. That's not going to be enough. They have to turn the entire business around. So, all right, Moose, I hope that I've shed some light on the payout ratio issues. Tomorrow it's Business Friday. We're going to have another podcast. And until then, don't forget to stay invested.
Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.